Countdown.
Good morning, everybody. It's Catherine Cook here, leading business advisor and founder of The Engine. And today I'm bringing back specialist providers to The Engine. We've got Andrew Skinner, he's a partner at Martelli McKeag, and also Kirit Lau from Walker Whalen, and he's one of the director partners there as well. Today we're here to discuss directorship and shareholders and who is in charge. As we all know, starting a business can be quite challenging, and also jump out starting their business without obviously thinking about implications. There's traps and pitfalls in operating a business, and you need to actually do it the right way. So let's start with good morning to both of you. Andrew, how are you doing?
I'm okay, thanks, Catherine, but you know, the hair is starting to look pretty buffy.
I was going to say something, but I won't. It's really helpful for those who don't have hair at the moment because, you know, they can just shave it off. But yeah, it is starting to look a bit hairy out there for us. And Kirit, have you got that stain problem? You're looking a little bit sharp there, Kirit. Have you got a hairdresser at home?
I have got a hairdresser at home. Good morning, Catherine. Morning, Andrew. Yes, I've been quite blessed in that respect. So my little boy and myself actually did get a bit of a number 5 or number 6, whatever you want to call it, over the weekend, and that actually made it all happy again. So.
Oh, that's awesome. I guess it's moments and memories like that will take away from this COVID lockdown. That, you know, giving us that time with the family. But I like everybody else, and we were just talking about it as we came on. We really just want to get back to regular life. So look, we're here today to talk about directorship and shareholders, and we're going to do this succinctly. And look, the reality is we're not going to cover everything off in the 30 minutes. So we're going to give you something to take away and think about. So Andrew and Kirit, you know, the three of us, we quite often come across a lot of businesses who, you know, they start out in business, they take on board, you know, obviously other shareholders and directors, and quite frankly, it becomes unstuck. So I'm going to actually kick off with you firstly, Andrew. You're in the litigation part, and you know, naturally you deal with a lot of this sort of issues, and wouldn't it be good to have the prevention over the cure? So what are your thoughts around jumping out the gate and suddenly we wake up and we go, we've got 3 people we want to work with, we all want to be shareholders in a business, we've got a great idea, let's do it, and before long, we know 5 years down the track, we actually don't even like each other, or even probably sometimes 6 months down the track. What are your thoughts on that?
Oh, look, it's a really good topic, Catherine. So thank you for pulling this together today. Yeah, so you've got a few people and you've got an idea and you want to pull together a business. It is really important to start thinking about roles and who is going to do what and what your expectations are of the other people you're getting into business with. And we've had a couple of these sessions now, and in both of them we've talked about the need for a shareholders agreement. So the shareholders being the people that hold the shares, that own the business, and having a robust agreement between the 3 of you, picking up a lot of the concepts that we've talked about before around, well, what is this business going to do, some of the technical things around transferring shares, dividend policies, all sorts of stuff. But in focusing on today's topic, it's really about, well, and what we like to do with our shareholders agreements with people is to actually say, well, what's everyone's role going to be in this business? Do you want to be are you a passive shareholder? You're just going to own shares and not be that involved in the business? Or are you going to want to be a director? And have you got specific skills that we're expecting you to do in that role? So yeah, that would be my initial sort of comments on this. Really good idea to sit down and work out between the 3 or 4 of you who's doing what.
Absolutely, and I also talk to businesses about actually having a backing document, like a memorandum of understanding, so that you kind of know when things go wrong, because things do go wrong, and I'm not trying to be negative here, it's a reality of life, and having that as a document that you actually review often. Is that something, Andrew, that you work with your client before? I mean, obviously you've got the shareholders agreement, that's the establishment of the business, but that backing document is so important in my view, because the shareholders agreement is just one thing. It's how do we navigate through those difficult waters?
Yeah.
What's your thinking around that?
Look, I think it's a really good idea as well. I mean, we build in some of those concepts into our shareholders agreement sometimes, or it's equally good to have it in a separate document. But really what we're trying to do here is actually that the document is great to end up with, but it's actually getting people to think about those things early on to work out who's kind of doing what, I think is the important thing. And before we go too much further, I think we should just be really clear about some of the terminology we're using here as well. So we're talking about directors. So that's an official role as an officer of the company that you have to notify Companies Office about. And that comes with, and really the directors are the governing mind of the organisation. They set the strategy and the direction for the company. And they have a very important role and have a number of duties in the Companies Act that they need to actually deliver on when they're fulfilling that role, as opposed to a shareholder which owns shares in the company or a part of the company and doesn't have those same duties or responsibilities as far as the company is concerned. So, yeah.
And realistically, those lines can get quite blurred. So it's really important that you do actually differentiate. Kirit, I'm going to cross over to you now. Obviously, you know, in terms of tax, you know, when people are starting out a company and they're investing money in the business, I see a lot of companies who have invested a lot of money but are paying themselves a wage instead of taking drawing. So maybe you could give the viewers a bit of a narrative around a shareholder's account in terms of their balance sheet and best practice. And I'm sure there is.
Yeah, sure. Thank you, Catherine. Yeah, the shareholders' current account is quite an important area when you're starting up a business, and a lot of individuals do not understand the difference between drawings and having salary. What they think that it's one of the same. So any money that they take out of the company, it's income to them, and that's what they pay money on. But there's a bit of science behind the whole thing, where a lot of it is other income, which is getting generated when you operate a business, and the others are a repayment of your advances that you have initially put in. And it's a combination of both of those that actually make up your overall shareholder current account. And this is where a lot of different parties, when they are coming in together to form a business, they get a bit puzzled to say, what am I actually putting in and how do I value my contribution in? Because somebody would just come in with a skill, but no financial input in this thing. And they think that they're equally contributing into the business as somebody who's actually contributed financial funds. But at the end of the day, the balance sheet doesn't actually look at intangible assets. It actually looks at more or less what physical cash has been put in and physical money that is being offered to shareholders. So further down the line, when the shareholder who's put in the money is asking for repayment of his loan, the other shareholder normally gets quite upset because he thinks that he's contributed similarly in the way of skill, and that has got a value. So yeah, it is quite interesting in that respect.
And I guess really what's probably even equally important is understanding your obligations to the IRD, because I do see a lot of people with overdrawn shareholder current accounts. So, Kirit, you also see that as well. What are your recommendations around that? My recommendation would be to ensure that you work closely with your accountant and not just once a year for tax return, just to mitigate that risk factor. What would you be saying to people right now?
Yeah, so with that, I think there needs to be an understanding of what is getting taken out of the company and what is actually then considered to be income. And if it is income that you're taking out of the company, then yes, it needs to have tax paid on it. Generally, people overdraw the current account because they have felt that all the money in the business belongs to them. But technically, it doesn't work that way. You know, there's money that is owed to the taxman. There's money owed to individuals that eventually you would have to pay back. So by overdrawing the current account, you end up owing the company money rather than the company owing you money, which is quite a different space to be in, and that's got all sorts of different tax implications around it, like fringe benefit tax, etc. So it is quite important to talk to your accountant quite regularly in this respect, and to know exactly what is your entitlement and how much you should be drawing down, and what you can actually do to ensure that you do not end up in a sticky situation further down the line.
Absolutely.
People can end up in quite a sticky situation, can't they? They don't appreciate that distinction. And I've had one earlier this year where there was quite a substantial sum that person ended up owing the company and was paying significant interest on that, and it was very tricky to sort out.
Yes, it's good money paying after bad money.
Yeah.
Money gets wasted along the way so much.
And I think reality-wise, people need to understand their fiduciary duties as a director, because realistically, Andrew and Kirit, is if I am overdrawing my shareholders' current account, and obviously, the company's not paying creditors, then there obviously can be a claim back on me as a director should the company go into receivership and liquidation and all those sorts of things. So, Andrew, you I'm sure, and Kirit, you've dealt with people with receiverships and liquidations who've come to you and asked for your help. The reality is you've got to actually own where it is. But how do you navigate? If I start with you, Kirit, how do you navigate? You've got a client who's not maintaining their fiduciary duties and is really technically insolvent, and they're a director of the business. How do is it recoverable?
Well, it's taking it case by case. I mean, first of all, you've really got to explain to people what their roles and duties are as a director, and not a lot of people probably really appreciate exactly what's in the Companies Act and what is required, and it's a pretty high standard. You've got to act in the best interests of the company in good faith. Got to act for a proper purpose at all times. We'll come on to some of the interesting examples I've got around some of those and what directors get up to. And you've got an overall duty of care to sort of, act as a responsible and professional director. So, and to your particular question, you've also got obligations around reckless trading in terms of committing to obligations when the company can't actually afford to commit to those obligations. So I think working closely with someone like Kirit and yourself, you would work out exactly what is the position for this company. And there's been some interesting cases this year as well in this sort of insolvency space around at what point you really need to actually start thinking about putting the company to liquidation if things aren't recoverable, to avoid that personal responsibility.
Oh, look, absolutely. And Kirit, I mean, obviously that's an area that you work a lot in that business recovery space as well. You're not just, maintaining, obviously tax planning and growth and all that. You do get those companies that, come to you and they're in a very difficult situation, difficult waters. How do you manage that? Is it something that you tend to work really closely with them on recovery, or do you work with a specialist in that area, or are you the specialist?
All of the above, to be honest. So we do.
And sorry, before you get into it, are you the counsellor as well? Because
we do wear many different hats in our normal daily lives. So when it does come to the situation where a person has come to you to say, hey, I'm running out of money, I can't pay my creditors, can you please let me know what are my rights and obligations in this thing? And then once you start digging deep into this thing, you normally have found out that the person has overdrawn more funds in their normal day-to-day lives because they've had things that have happened in their personal lives that have required more funds. So, for example, if somebody decides to renovate their house, and that renovation goes over budget, they tend to think that the company money is their money, so they can pull it out for renovating their private house. But unfortunately, that gets considered as drawings, and those drawings then, disable you to pay your creditors, which then means that if you're in that sticky situation, you have to navigate your way out. So you'd start discussing as to what sort of opportunities you have with either injecting more funds back into the company by using your house as the equity, or you actually start looking at who are the creditors, whether you need to start liaising with them to get a payment arrangement. Under the COVID arrangements, there's debt habitation, whether you need to go into that for a little while you get yourself out of there. So there's all sorts of different solutions and things. And generally, the last man to pay is the IRD. With all of this, people think that the IRD can wait and everybody else needs to be paid first. However, the IRD has got the highest rate of penalties and interest that they impose on unpaid taxes. So when you start going back to the IRD to negotiate, they're not that so friendly when your history is not great with them. If they can see a common pattern where you've been ignoring them for the last 2 to 3 years, etc., then you go and ask for some help. The IRD are not going to be that kind to you, but if you are proactive and if you've got one or two, say GST returns outstanding and PAYE payments not being made, you approach them and start engaging in conversations right there and then they will be quite sympathetic to your situation and start moving on with it. But if you leave it for 2 to 3 years and go back to them, I've got a classic example. A person has filed all his PAYE returns for the last 3 years. He's in the hospitality business, thinking that things are going to go right pre-March 2020, and and he didn't pay his taxes then. Sooner or later, he realized that COVID is over here forever, and he's actually now a further 100,000 down on his PAYE payment. So he's chasing his tail, and the idea has given him a statutory demand to say, you either pay or we liquidate you. So those are the sort of examples that we see on a daily basis. So engaging your accountant and engaging all your business advisors, etc., it's quite important right there and when it happens.
And I'm going
Kirit, can I just ask you? I mean, we've talked about that a bit in the session already. That people, and I saw it a lot in the previous business I worked for, with that people do tend to think the company money is their money, and that seems to me to be one of those areas where, as you say, some expenditure comes up and there's money there, so they grab it. And do you have any kind of practical tips that you advise clients to kind of sort of just make it clear in their mind they do need to go through a proper process before they start, withdrawing those funds from the business?
Oh yes, many times, and there are some good guys who do actually listen to that advice and do come into you right early in the piece, and they do make a lot of plans. But there are some individuals who actually get stuck in a situation. They think that instead of me going and talking to a professional, which is going to cost me more money, I will just try and navigate the problem by myself, and they get stuck further deep into this thing where they can't get out. I mean, and generally when we have the year-end close-off meetings with our clients, when we do either the year-end tax returns or we do quarterly meetings or whatever it is, we've always told our clients to really keep on top of your cash flow, really know what your personal commitments are going to be and also the business commitments, because they go hand in hand. And 90-odd% of New Zealand businesses are SMEs. So the line between the director and the shareholder gets quite blurred with mum and dads involved, and that actually then comes to this tricky situation to say, we're stuck in this. How do we navigate out? And generally, it's not a happy ending sometimes. So you just want to make sure that you do get to a situation where you can navigate out.
I just want to jump in there. Obviously, I talk about it quite often. We bury our heads in the sand. The problem doesn't go away. And the reality is if you think about the cost of the people that you need to help you in a situation, you say you can't afford it, then you need to look in the mirror and go, can I afford to lose everything? Because that's the reality. Is if you don't get good supportive people and experienced people around you, like the three of us, to help you navigate these waters, the reality is that you will end up on the other side of actually losing it all, and you'll still end up needing us to help you, and it's going to cost you a lot more. So prevention over cure is so topical for me, and I always say to people, look at the loss and can you afford that? And the reality is no, so then you can afford us. And we're not here just to clip the ticket. We're here to help you keep going and to help you grow and get out of the issue and front foot it. Front foot it. It's like, as I said just before, burying your head in the sand. Even though you've got your head in the sand, you've still got your backside out of the sand. You'll still get that ass bitten, excuse the expression, to speak.
I think too that we've talked about businesses that aren't doing so well, but also the structure between directors and shareholders is also really important in businesses that do very well as well.
Yeah.
And I've had examples recently where businesses have been set up with shareholders that were going to contribute a lot to the business, and so they were given a significant shareholding, and ended up just becoming a passive passive shareholder. And then the business has done very well. And over time, those directors and shareholders who are contributing a lot, they get a bit disgruntled when these shareholders are just sitting there and they are getting dividends for not doing an awful lot. And it's actually, there's not a lot you can do about it to move a shareholder on. So it's just important to really get that structure right, you know.
Yeah, and it's also equally important to actually look after those shareholders, because when you actually do need them to invest more money in, and you are not being responsible with the money they've put in, and you know, I've come across a couple of companies who've taken on some shareholders and are still using that money personally, but need to understand that they still have to front up with how that equity has been spent in terms of the you know, the reporting factor. Andrew, I'm going to just come back to you. You know, and I'm really glad that you highlighted about businesses going well, because sometimes it's easy to dwell on the negative, the aspect, and I'm really passionate about prevention over cure. And when you just talked about businesses going well, I mean, you summed it up really well. If you get the roles right and everyone has an expectation and understanding of what that looks like, then you can all move forward. But typically you've got, you know, a couple, and they start up a business together. You know, I think it's a really good idea. And they start up a business together, and, you know, then relationship issues happen, or, you know, they run into financial problems or whatever. I see a lot of businesses with the husband and wife as directors, and I've got a viewpoint on that. Have one only as a director to limit the risk factor. But what does that mean for the one that's not a director? You know, I mean, there's still a 50-50 shareholding in most respects. But
Yes.
what would advice be around that?
Yeah, well, so when you're thinking about rights of shareholders, then essentially a share is really, they call it a bundle of rights. You know, you get a right to vote. You get a right to share in a distribution or a dividend. You get a right to share in the surplus assets on a winding up. And so it's really important that people understand that when you're a shareholder, you're actually just given certain rights. And then the Companies Act allows you to vote on certain matters, really quite important matters, to be able to have that say. And so for your example, one of the key things that get voted on is who's going to be the directors. And what you need is actually a majority of the votes to appoint or remove a director. That's what the Companies Act says. You can change that by a shareholders agreement, but that's what the Companies Act says. That's the starting point. And so when you're thinking structurally about your business and who has this number of shares and who's got that, you need to be thinking about those key thresholds to make sure that you can actually, the right people are making the right decisions. Because in a situation I had recently, it was quite fortunate where it was a family situation that was set up. A mum and dad got a significant shareholding, and one of the kids and partner had the majority shareholding. It was that classic situation which I referred to before. Over time, the parents were getting a lot of dividends for not doing an awful lot, and they were directors as well. And so the kids were able to remove the parents from being directors, but they can't move them on from being shareholders. They've still got those rights.
Oh, absolutely. And just discussing minority shareholding, I know of a company who, you know, had a really good product that ended up going to the USA, and ended up having an issue with the minority shareholder not being able to move on to ensure that they were able to go forth with this big expansion plan. So they had an equity shareholder in the USA who wanted to buy a good bulk of the business, but they had that minority shareholder that they had to move on. And advantages for the minority shareholder in the end, because they got a really handsome amount of money, but it could also hamstring an opportunity.
Yeah, and that's sort of why you need to have a shareholders agreement, to have some drag along rights, so you can force those people to sell. Otherwise, you will get greenmailed if you don't have that right.
Based on what you're typically dealing with, though, Andrew, with a husband and wife situation, I know every situation is different, but do you have a viewpoint on whether both husband and wife should be directors rather, and you know, or would you encourage one to be a director and one not, just from a mitigating of risk point of view?
Oh, I wouldn't want to have a strong view either way. Sorry, Catherine. I would want to.
I thought I had him, Kirit. I thought I had him.
Almost.
I know where you're going with this, but I would hesitate to have a kind of a rule of thumb on this one. I would prefer to meet the people and understand their skills in the business and then do what's right for them. Sorry.
Absolutely. No, look, there's no right or wrong answer. It really is just, and you're right, it does come down to.
But people should be aware that generally the directors get asked to guarantee things like leases, etc. So what you're saying is quite right. You know, if you can mitigate some of that risk by one of you, but then is actually that the right decision for the business to worry about that risk so much that you don't have you both involved as directors? I mean, it's just, yeah.
Yeah, and I guess it's also asking yourself the question if we're worried about that being a risk, which we sound in being in business as well. So there's a whole bunch of reasons and rhymes as to why we do things. Kirit, do you have a viewpoint on that? We may as well know you at the same time.
Yeah, once again, it comes down to the situations, and generally, when a husband and wife team does go into business, they are looking to grow. They don't actually go in thinking about the negatives of going into business. They're always thinking about positives, but under most circumstances, they're almost putting everything they've owned on the line to get into the business. So mitigating some of the factors would be okay, but once again, you don't actually plan to fail. You actually want to succeed. So when you are going in and you are in the succession part, it may be that in the future you may want further investors to come into the business that you're putting in, which means that having both the parties in there at all times would make it a lot more easier to say yes, we're doing it, or no, we're not doing it, because generally goes well when the money's there and there's cash in the bank, but when the money starts running out and money is a big discussion topic at the dinner table at home, that's when things start becoming quite sour. So you would want to
absolutely, yeah, and don't take your conversations home to the dinner table. That's my best advice. Make sure you structure that or time block the time that you discuss business so it doesn't flow over into your relationship, because that's what we were talking about last week, and the dangers around balancing the scales of personal and business. Kirit, I've got a burning question for you. It's very topical and I get asked all the time. And I know the answer, but I just want to talk about it from your point of view. Should I have an employment contract as a director to be an employee of my business?
I would generally recommend yes, because that sets out what your obligations are as an employee of the company. And generally, if you can fit it in with a job description, it would be really good. There are some companies which are called look-through companies, and the look-through company tax rules say that if you do need to get paid a PAYE salary, you have to have an employment agreement. So there's no downsides to having an employment agreement. If anything, it just concretes all of the understanding that you have for that and puts it all on paper. So there's no downsides to an employment agreement. I totally advocate having an employment agreement wherever you can.
I guess if you ever get audited, it's good to have a paper trail as well. And most companies will go through an audit process at some point, and they should be prepared for that and have it ready. And it's not onerous. It's actually just ticking off boxes and making sure that you're doing everything that you need to be done right. And it also sets you up best to be able to move on that business as well. We are going to wrap this up, and we've just about out of time. What I'd like to do, guys, is I would have liked to have got into a little bit more about the different types of directors, and also talk about the benefits of having a board and providing an objective viewpoint. Would love to get you guys back on to discuss that sometime in the next 4 weeks, because we are often making these decisions on our own, or talking to our accountant once a year, or going to our accountant, lawyer and or business advisor when things go wrong. And we really, talking about that prevention over cure, if we had those non-directors or boards in place, we would be able to kind of not feel alone and make those decisions more soundly. So, Andrew,
it's a really, really good topic, Catherine, and a really good point. I don't think that sort of small business sector in New Zealand uses enough independent board members and enough advice all the time. So I think it's a really good topic. I'd be happy to come back and have a talk about that.
Absolutely, and realistically, you know, understanding your obligation by law, full governance and care and duty and responsibility is so important. So most directors are wearing multiple hats in the business, and it's good to actually step out and just helicopter view over at a board meeting where the business is at, so you can be strategic in your planning. So, Kirit, wrapping this up, what's your top tip that you want people to take away today around directorship and shareholders?
I would say always maintain the line of distinction between a director and a shareholder. The company money is not all yours. As a company director, you have got obligations to the creditors, fiduciary obligations, etc. You would want to make sure that you do that as best as you can, because there's no going back. Because once you get into trouble with the taxman or your creditors, it's a hard way out. So always remember to make sure that you don't treat the company money as your own money.
Oh, that's a great tip. And Andrew, you?
Mine would be just have that clear discussion from the outset around who is contributing and doing what in the business, and then naturally map that out, whether that fits in a director role or it's just a shareholder role, and have it either in the shareholders agreement or in the document you were talking about, but have it recorded.
Absolutely. And my tip is on Friday, the 22nd of October, the government released a up to $7,000 package for business owners to get support from people like us. The Engine is a leading service provider to the Regional Business Partner Program, and that up to $7,000 does include coaching and implementation. The type of implementation that you could be looking at could be around cash flow planning, shareholders agreement, and all the things that you thought about doing that you know you need to do. We're here to help. Thank you for watching us today, and we'll be back again in the next 4 weeks to discuss why a board is so important. Thanks, guys. Really appreciate your time.
Thank you, Catherine. Thank you, Andrew.
Thanks, Gavin.
Have a great day on day 71 or 70, whatever.
Can't keep up.
Cheers.
See you later.